Hi. Let's learn about the Gordon Growth Model, GGM, and how it is used to determine the intrinsic value of a stock based on future dividends. Today, we will talk about the Gordon Growth Model, GGM. The Gordon Growth Model is a formula used to determine the intrinsic value of a stock based on a future series of dividends that grow at a constant rate. It is a popular and straightforward variant of the dividend discount model, DDM. The GGM assumes that dividends grow at a constant rate in perpetuity and solves for the present value of the infinite series of future dividends. The Gordon Growth Model formula is based on the mathematical properties of an infinite series of numbers growing at a constant rate. The three key inputs in the model are dividends per share, the growth rate in dividends per share, and the required rate of return, RR. The formula for the GGM is P equals D1/R(G), where P is the current stock price, G is the constant growth rate expected for dividends, R is the constant cost of equity capital for the company, and D1 is the value of next year's dividends. The GGM attempts to calculate the fair value of a stock irrespective of the prevailing market conditions and takes into consideration the dividend payout factors and the market's expected returns. If the value obtained from the model is higher than the current trading price of shares, then the stock is considered to be undervalued and qualifies for a buy, and vice versa. The Gordon Growth Model values a company's stock using an assumption of constant growth in dividend payments that a company makes to its common equity shareholders. The GGM assumes that a company exists forever and pays dividends per share that increase at a constant rate. To estimate the intrinsic value of a stock, the model takes the infinite series of dividends and discounts them back to the present using the required rate of return. The main limitation of the Gordon Growth Model lies in its assumption of constant growth in dividends per share. Companies rarely show constant growth in their dividends due to business cycles and unexpected financial difficulties or successes. The second issue occurs with the relationship between the discount factor and the growth rate used in the model. If the required rate of return is less than the growth rate, the result is a negative value, rendering the model worthless. As a hypothetical example, consider a company whose stock is trading at $110 per share. This company requires an 8% minimum rate of return and will pay a $3 dividend per share next year, D1, which is expected to increase by 5% annually, G. According to the Gordon Growth Model, the shares are currently $10 overvalued in the market. The three inputs in the GGM are dividends per share, the growth rate in dividends per share, and the required rate of return, ROR. DPS is the annual payments a company makes to its common equity shareholders, while the DPS growth rate is the yearly rate of increase in dividends. The required rate of return is the minimum rate of return at which investors will buy a company's stock. The GGM's main limitation lies in its assumption of constant growth in dividends per share. It is very rare for companies to show constant growth in their dividends due to business cycles and unexpected financial difficulties or successes. The model is thus limited to companies with stable growth rates in dividends per share. Another issue occurs with the relationship between the discount factor and the growth rate used in the model. If the required rate of return is less than the growth rate of dividends per share, the result is a negative value, rendering the model worthless. The Gordon Growth Model is a popular formula that's used to find the intrinsic value of a company's stock. Generally, when the model's calculation results in a figure that's higher than the current market price of a company's shares, the stock is seen as undervalued and should be considered a buy. When the GGM result is lower than the current trading price, the stock is seen as overvalued and should be considered a sell. A downside of the Gordon Growth Model is its assumption that dividend payouts grow at a constant rate. This makes it useful only when considering the stock of those select companies with dividends that match that assumption. Here are 5 key takeaways. 1. The Gordon Growth Model, GGM, is a formula used to establish the intrinsic value of company stock. 2. It assumes that a company exists forever and that there is a constant growth in dividends when valuing a company's stock. 3. The GGM works by taking an infinite series of dividends per share and discounting them back to the present using the required rate of return. 4. It is a variant of the dividend discount model, DDM. 5. The GGM is ideal for companies with steady growth rates, given its assumption of constant dividend growth. Hope this would help. Thanks for watching.